Feels like forever. And I remember the first time I saw one. I was sitting at a restaurant with my sister-in-law and her boyfriend, and he has his phone, and he's like, oh, man. I'm like, what is that? He's like, oh, it's this iPhone. I'm like, oh, man, what a waste. Like, I would never use that. And welcome back to the Behind the Well show. I'm your host, Roger Abel. I'm joined here again with Elias, Randel, and we're here to talk about an article that we recently read. It came through from Franklin Templeton, which, if you're not familiar with them, they're a large institutional money manager and provide products for retail clients. And they're founded by a guy named Sir John Templeton. And I'm reminded of this because we actually have this poster in our restroom on the back of the door when you come out. And he had a famous quote, which I think is actually really, really relevant today, Elias. And that quote is, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die in euphoria. And if you think about that, right now, I don't know where we are in that cycle. You know, there's still $5 trillion of cash sitting on the sideline. But I feel like there is a level of euphoria in the market with a certain segment of investors. And it's the younger investors, and a lot of this has been driven by the platforms like Robinhood and, you know, millennials getting into day trading and be active about this. And you can see it in a couple of things that have happened recently. Elon Musk came out, I think it was a week or two ago, and said something about some messaging company, and it caused the stock to go through the roof, and it was the wrong company. It wasn't even the right company that he was talking about.
He misspoke, or people misunderstood?
People misunderstood and started buying a company that was a nonprofit, and it just drove the stock price through the roof because people are so euphoric about buying and driving up the price of these stocks. So I always think back to that. I'm always trying to figure out where are we at in this market cycle, you know, from a personal standpoint. But then if you look back to the last 90 years, it hasn't really mattered. Right?
And you know, when you look back, and right now, so we're back to all-time highs in the markets. And I guess when I was reading through this, I was thinking about, you know, people are asking, okay, we're at an all-time high. When's the correction coming? What do I do right now? How do I get prepared for this? And I think this gives a good look at asset allocation and being diversified, the different options you have. And then the other thing that I was surprised by is, like, it's very popular to talk about unprecedented times right now, but we always have things that go on that you could consider unprecedented. When you break down each decade, you see, you know, we've been through wars, we've been through other sicknesses or flus. We've been through a lot of this stuff, and still the market has been resilient, and just the American economy has been resilient throughout time.
Well, that's a good point, because coincidentally enough, the day we're filming this is the day of inauguration. Yep. And one of the things Joe Biden said this morning was that we're in historically unprecedented times.
Right. And
I
disagree with that.
I mean, we've had these things all along. Yes, are we fighting a virus that we've never seen? Yes, but we've had, you know, flus in the past. We've had polio. We've had all these different sicknesses that we've got through. So I think just going back to this and to your point, 100% right. Just we're going to have different stuff the next 10 years that happens that will put us in unprecedented times because we've never seen it. It doesn't mean that you should be fearful about what's going on in the world. And part of this exercise today is just show the relationship between risk and reward through the different decades and how you would have done. And I was actually surprised as I went through this. Not totally surprised, but a little bit surprised as to what the best portfolio was in most decades, even considering all the bad things that happened in those decades. So when we talk about asset allocation, we were really talking about the diversification of portfolios between cash, bonds, or fixed income, and stocks or equity. Okay. And for this exercise and for this white paper, they really broke it down into 5 basic asset allocation portfolios, all the way from 100% stock to basically all income or all fixed income. And if you think about most people, I think if you said, hey, you have to live with 5 portfolios from an asset allocation standpoint, we could make that work for almost everybody.
Yeah, it really could be that simple.
When we do a financial plan, we really drive it down and get more particular, but you're really just trying to get somebody in their optimal portfolio, which is why we are huge advocates of financial planning, crafting a well-written financial plan to determine what portfolio is right for you. Because we have a saying, there's great investments. The question is, are those investments great for you? And the only way to quantify it is through a financial plan. So I'd remind everybody that if you don't have one, you can go to the website, btwealthshow.com. There's a button on there. You can hit the button to start a plan or contact one of our advisors. But for today, we're just going to talk about the 5 general asset allocation portfolios that you could potentially have or would be a potential outcome, for your portfolio. And when we talk about in these, we're going to name them aggressive growth, which is 80% stock, 20% bonds. Moderate growth, that's your traditional 60-40 model. Conservative growth, which is basically 40% stock, 40% bonds, 20% cash. And then a income portfolio, which is 20% stock, 60% bonds, 20% cash. And for the growth, it's just the S&P 500 and bond indexes. All that was used for the actual benchmark.
Yeah, and I'd say for these hypothetical portfolios, the other thing I liked about this white paper was it assumes rebalancing, which is something we talk a lot about and we proactively do for our clients. So, and that's an important thing because when you have areas of your portfolio that outperform, it is important to look at, okay, what maybe is it? It might be as simple as sell some winners, buy some losers, or if you need to have a 80% stock, 20% bond portfolio, and now you're running it like 85-15, how do you get back to that optimal portfolio for you? And these scenarios assume rebalancing through all these decades.
Well, think back to the last year and how important rebalancing could have been as a strategy if clients took advantage of it or individual investors did. So, yeah, let's just say you entered the year with a 50% stock, 50% bond portfolio. By the end of March, your portfolio was down, if that was your allocation, probably around 20%. Yeah. So now you actually had 60% in bonds and 40% in stocks. Had you have rebalanced, you'd have brought it back to 50-50, so you'd have sold 10% of those bonds, bought 10% back in those stocks, and now you've experienced this great run up from the bottom.
Well, yeah, and you would have been rewarded for doing something proactive and doing something that was prudent for your situation.
Yeah, it's proactive versus reactive. You reacted to the situation, but in a proactive way. It's kind of like my daughter when things don't go her way. I'm like, hey, that didn't work. Let's figure out how to turn lemons into lemonade. And she always kind of laughs because, she's like 4.5. She thinks it's funny, but I'm just trying to say, hey, it's not going to go your way. But how do we make a negative into a positive? And that's one of the ways you can do it. Conversely now, if you did rebalancing in April of last year, you're probably looking at doing it now because my guess is you've got an outweighed amount of stocks in this portfolio due to the rapid recovery that we saw in the market. You probably want to rebalance back the other way. And if you don't rebalance the other way, that's the greed kicking in that people have, right? Where they're starting to get greedy and say, hey, man, everything's doing so well. Why would I want to go back to the portfolio that I had before? So rebalancing is important. I'm glad you brought that up throughout this. But the first decade, and we go back to 1930, is the 30s, right?
Yeah.
And this is kind of a interesting decade. A lot of stuff happened. And I like to look at parallels, and I've been talking about this for a long time, but we had a Great Depression in the 30s. Well, we just had a Great Recession not too long ago. 12 years, it's getting longer ago.
Yep.
Great Recession. They had the creation of the New Deal in the 1930s. Well, we're probably looking at the creation of some form of a Green New Deal. So we can look at what happened back then, see what happened now. Does it really matter for somebody's portfolio? We also had the crash of 29, right? 16 million shares traded, and it started the Great Depression. We had 25% unemployment. Well, just 6 months ago, we had 25% unemployment. So there's all these parallels. And people start to get scared by what actually happened. I like to look at what did actually happen. So if we take a look at the average annual returns for that entire period of time, right? The stock market for 10 years is actually negative. Yeah. Slightly. It was down 0.5%.
Yeah. Basically flat, but yeah, down 0.5%.
And that was the average return. So if somebody had a 100% stock portfolio, they lost 0.5% of their money, which that's unfortunate, but it's not cataclysmic. It's not like they lost 80% of their money. They might have thought it was cataclysmic in 1929 if they lost massive amounts of money, during the Great Depression. But if they held on, they're okay.
Right, and that's also in a decade where you got kicked off with a big stock market crash at the end of 1929. And then what really stuck out to me, average unemployment was 18.23%.
For the entire decade.
Yeah, that's the average for the decade. So there were a lot of people out of work for basically 10 years.
And basically, of all the decades we're looking at, that's the worst. From a stock market perspective, that's the worst decade.
Yeah.
Okay. Bonds, long-term government bonds did just under 5%. So the best portfolio for the 30s was the income portfolio. If you invested $1,000, it would have basically returned $1,464 would have been the ending total. So I think what's interesting is this is the one period of time where the actual income portfolio over 90 years was the winner. And I'm fast forwarding here because I know what the answers are, but it makes sense. If you had that high unemployment, government bonds had the highest return, and if stocks were negative, your income portfolio and cash portfolio will probably be the best for the 30s.
Yeah, it makes sense. And so then we transitioned into the 1940s, which we entered World War II. So, and this is a good example when we were reading through this. So we entered into World War II. World War II wrapped up in 1945. And so for the first 5 years, our economy was really driven by getting ready for war, building airplanes and building tanks and ammunition. Well, and we have them today. We call them perma-bears or your pessimistic predictors. What the predictions were and what the talk was is regarding the economy and the stock market was we won't be able to transition back to a non-wartime economy fast enough, and we'll have a stock market crash, and we will also have bad economic times, which proved to be wrong, and that was untrue. And the 40s were actually good in the stock market and good for the economy. S&P 500 was around 9% return, and the unemployment was on average 5% for the entire decade. So to me, that's, you went from the 30s where your average unemployment was 18% down to 5%. And just like today, how we have people predicting, there could be a 70% stock market crash, 80% stock market crash. Those are just predictions, the same back in the 40s. And to me, those could be seen as logical predictions because we're in war and now we're coming back. We're not going to be producing a lot of those things anymore. But to me, that shows the resiliency of, the American people, our businesses, our economy, and our stock market.
Well, some of those predictions are probably based on recency bias, right? They just saw a Great Depression. Well, this has to happen again, or this will happen again. And we start to form opinions about, man, we spent all this money on a war. How are we not going to, have some kind of economic collapse from it? Well, if you have the parallel to today of coronavirus, we spent trillions of dollars on this. And it's exactly what the predictors are saying today is, well, we're going to have to pay this back. How are we ever going to get off a 0% interest rate? How are we ever going to do this without some kind of an economic pullback? And at the end of the day, they just don't know. I mean, markets can't be predicted. And this is maybe the first time in history where really that was proven. Predictions really don't matter that much. Predictions are just somebody's speak and somebody's narrative that they believe will happen. We've said it before. They'll be right eventually.
Right.
We just don't know when and how much does a person actually miss out on getting to the point where they're actually right.
Right. And we know on average there's at least a 15% correction every 3.5 years, which is really all the more reason to work with a professional who's going to help you not make bad decisions, and to have a financial plan that, we've considered those type of things happening. And then helping talk you through it, how to stick the course when it does happen.
Right. And, people at this point in time, there was no such thing as financial planning in the 40s.
Oh,
Not as
right.
it is in today. Today
Right.
it was, this is just a stock market. And, I wasn't around, but I would guess that the stock market at that point in time was seen as more speculative versus this tool to get someone to retirement.
Yeah, I think, well, there might have been some people starting to talk about behavioral finance and like buying and holding, like maybe like Benjamin Graham or someone, but not like today where there's a lot of people that talk about behavioral finance and how to build wealth over the long term.
Sure. So then Elias ushers in the Eisenhower years, and this is where we started to see some really massive reaction to civil rights movements. Elvis was rocking the world back then. And we transitioned to more of a consumer nation as households started to buy their first cars, and some of the technological advances and more modern amenities for the time became available, which really started to grow stock prices. I mean, they'd reached their highest level since 1929. They were followed by an 18-month bear market from April 56 to October 57, where the S&P declined 19%. So there was still turmoil, but we saw some growth that was driven here. And coincidentally enough, guess what portfolio was the best again? The 100% stock portfolio.
The all stock portfolio.
But I think it's important as we talk about this being the best portfolio, it's not because it's the best portfolio for any one person, right? If your financial plan dictated that you could have a 100% stock portfolio and your risk tolerance also kind of dictated or re-ingrained that was appropriate for you, it would be good for you. And if you think about it, the markets went up over time. I mean, a lot. So most of the time, the stock portfolio is going to be the correct portfolio. But the S&P 500 in the 50s was up a little bit over 19%. We saw bonds actually average negative. So long-term government bonds were down just ever so slightly. And the unemployment rate was about 4.5%. So one of the trends I'm kind of seeing is, we have unemployment go down again. We had this massive growth. But I think one of the cool things that I found from the article, and I didn't think about it, is that's when the vehicle became like mainstream. Everybody has started to get a car.
Yep.
Well,
cars and TVs were starting to be in every home in America.
Cars and TVs, and today it's cell phones and hoverboards. I don't know.
Right.
So the 50s were a very prosperous time for anybody who decided to invest with some level of risk in a portfolio.
Yeah, and what stood out to me, and I guess to kind of draw comparisons to today, so there was an 18-month bear market where the stock market went down 19%, just over 19%. Well, so then I was wondering, okay, so if this year when coronavirus started and our markets went down like 35% or more, how would people, and it was short-lived, right? But how would people have responded differently if it would have been a longer drawn out market of like this situation where it's 18 months?
Yeah, I think that's a curious question, because a lot of people knew it was happening, but they were more concerned this year about their health, their safety. I mean, they were probably watching their money, but they were more watching the news to see what was going to happen with this virus that had just captivated us as a country, and then the reaction to it. And by the time they probably got their, so think about this, they got their March statement, which, it's down.
Yep.
By the time they got their July statement, they made a good chunk of it back. So I think the reaction level wasn't that of lots of pain, where if you got the March statement, you were down 10%, and then you got the July statement, you're down 10%, another 10, and you just constantly keeps wearing on you.
Yeah, it seems like it almost be more like death by 1,000 pricks. Like, can you take it?
It's kind of like when my daughter keeps asking for the same thing over and over and over, and by the 40th time, you're like, whatever. You just, uncle, I succumb to whatever is going to happen. And I think you're right. And it's one of the things that I think's happened with technology, which we talk about in a previous show, is that the speed of information is so quick, it's moving markets faster too.
Right.
I mean, something happens, you can literally go on here. You can be on Facebook or Twitter or whatever you're on, get the information, make a trade within seconds. Well, that just didn't happen 20, 30, 40 years ago. So it took people longer to react on both ends, longer to panic, and longer to get back.
Right. And we should point out, even with that 18-month bear market, for the decade, stock market in general is up over 19%. So, and we're not predicting that's going to happen again, right? But just something to think about. If it were to happen, do you have a plan that's going to keep you on track?
So then, Elias, the 60s usher in this kind of social revolution. And I think when we think back to this, we think of hippies and all this different stuff.
Vietnam War.
John F. Kennedy was killed. Martin Luther King delivered his I Have a Dream speech in 1963. In 1963, coincidentally, is when we sent military to Vietnam, like you mentioned. The stock market actually recorded 3 bear markets in this decade. So to level set, bear market is a correction of 20% or more. That's the definition of a bear market. But think about this. So 3 times in this decade, there were corrections of 20% or more. And if you told most people that 3 times in the next 10 years, the market is going to go down at least 20%, 3 different times, they would panic and be like, I don't even want to be involved. So it just lends to the foresight of, oh, things are going to be bad.
Yeah. Well, and so that brings up a good point. So like for a younger person who's in the accumulation phase, so they're doing their 401k or their IRAs outside of work, you can look at it 2 ways, right? So yeah, the money you have invested 3 different times in the 60s would have lost value. But if you're accumulating, those 3 times were really good buying opportunities for your long-term savings plan. But not people in retirement, they might feel a little bit different about that. Well, but what do you think about that?
I agree with that, because if you're doing what we talk about, and that's having a systematic savings plan, you didn't even have to figure out when the 3 best buying opportunities were. You automatically took advantage of them, right? Because there's two ways of capitalizing this buying opportunity: trying to time when it's going to happen, which I think we've demonstrated time and time again. We can't time when to sell a market or to buy it. We don't know.
Correct.
There's probably times in between where you're a little right, but I know there's one way to be right, and that's an automatic, systematic savings plan that people have in place.
Yeah.
So you were right 3 times in your buying opportunity. But I think even for those people who are in the decumulation stage or distribution phase, it doesn't matter if you have a right plan. So if you think about the bucket strategy that we create for people when they're in the distribution phase, it's a portion of liquid assets or cash alternatives, income producing assets, and growth assets. Well, arguably those growth assets are what would have seen the largest up and downs, right?
Yeah.
Well, we're not planning on those for 7 to 10 years, so it didn't affect this plan. And I think too many people actually go into retirement and they think it works like their 401k, right? So for accumulators, putting a little bit in over a really long period of time works really well.
Right.
And then some people think, oh, now I'm retired, I do exactly the same thing. I take a little bit out over a long period of time and work really well. Well, it may or it may not, because it really depends on where you're pulling the assets from. If that person in the distribution phase would have had to take money or make a sale 3 different times at the bottom of the market, they're just exacerbating their loss, and they're locking in the loss. So for people that are in the distribution phase, this is why it's critically important for somebody to have a plan for distribution versus the same plan they had for accumulation. It's just a little trickier.
Right. Yeah, because it's like you're just saying, if you have to sell at the bottom of a market, well, that drastically affects your plan, way more negatively than selling at the top, right? If you're selling at the top, things are pretty good.
Right. So for the 60s, we've talked about the doom and gloom 3 bear markets. Most people are thinking, man, bad decade, right?
Yeah.
Well, truth be told, it was actually fairly positive. The stock market has 7.81% average rate of return. And most people, if you said your money's going to go down 20% 3 different times, but you'll still end up with a 7.8% rate of return, they probably say, well, I'd take that. It's just mentally preparing people that these market cycles are normal. They're going to ebb and flow. They're going to go up over time, and not get all that excited about what happens. And this decade today would have been a very good reason to have that financial plan, because every time there was this bear market and people started to panic, you'd have the ability to go back and tell people, or show people, I should say tell,
Right.
but demonstrate to people why taking the amount of risk they are taking, what portfolio or asset allocation is optimal for them. You could demonstrate to them with some level of certainty why they're doing it, versus the default option when you guess, which is get out of the market.
Right. And, we talk about all the time, at that point, you're helping someone quantify their decisions, and you're giving them confidence and helping them, sleep at night so they can go through, if we were to have 3 bear markets in the next decade, especially after the bull run we've been in, that would probably cause a fair amount of panic.
We would be busy.
We would. We'd be very busy.
We would be busy because, a
lot of phone calls asking, how are you doing?
Think about the last decade.
Yeah.
If you're an investor under the age of 35, you haven't seen any pain in the market until this last March, and it came right back.
It was relatively painless because it was so fast.
Right. So you haven't seen those delayed, drawn out bear markets that just start to wear at you and eat away at your morale. So, Elias, that ushers in the 70s, and this is where we start to see a lot of change in the world. The Vietnam War has ended. We start to see an energy crisis that sparks an economic crisis. Nixon changed foreign policy by visiting China and Russia in 1972. That hadn't been done before. Nixon was impeached. The Watergate scandal. Apple and a company called Commodore started the first producing personal computer. You think about how far we've come since 1970s to today. Here's your computer today versus back then, like these big boxes.
Right.
And the thought that Apple was started in the 70s. And it brings me back to a class I took in college, Apple. So this would have been like early 2000s. And I was in a finance course at the University of Iowa, and it was this trading course. It was teaching you how to execute stock trades, and it was all fictitious, but followed the stock market of 4 stocks. It was Apple, IBM, Microsoft, and another one. And I remember back at that time, of all those stocks, Apple was the worst. It was the worst stock. Oh yeah, it was the worst because iPod hadn't come out. The Macintosh wasn't. Who was using a Macintosh in 2000? You might have seen it in some schools, but nobody had a Mac at home.
Elementary schools had them.
Yeah, but you didn't see it in the home. I'll never remember. The stock was trading $10 a share. And now think if someone would have had the foresight, to invest at that point in time. So I just think it's interesting because I feel like Apple for 30 years just wasn't well known. And today it controls 50% of America's life. 50% of America run their life on an Apple device. At least. I don't know the real number, but it's a lot. Everybody in here has an Apple device right now. And then the stock market plunged 45% from January 73 through December 74.
So that's a pretty painful year right there. 45% from January 1973 to December 1974. But with that, people were still rewarded for the decade. For the decade, the market still did 5.86%. So if you could have stomached that and stuck to a good plan and kept buying, you still would have been rewarded almost 6% annualized return. The other thing I thought was interesting was I think this is only decade where a conservative growth portfolio was the best performer. So that's 40% stock, 40% bonds, and 20% cash.
Yeah, and here's what I think most people remember about the 70s. It was this decade of hyperinflation, super high interest rates. You hear the stories, well, I used to get 12% of my CDs, and you did, but inflation also went with it. In fact, I'm looking at this chart by Franklin Templeton, and that at that point in time, short-term interest rates were 8%.
Ouch.
You can't find long-term interest rates on high-yield debt that's 8% today.
Right.
So if you think about that, that's one of the reasons that the conservative growth, or that model that holds more fixed income and cash, outperform the stock market. But I look at that too and say, well, so you had a 45% downturn in stock investors still made just shy of 6%.
Right. And annual inflation being over 7%. And that's really high. All these other decades are a lot lower than that. And right now there's a lot of predictions out there of, they're calling it runaway inflation or massive inflation, however it's worded. But to me, this decade shows that you can have higher inflation and you can still get returns in the stock market.
Well, the other thing that sticks out at me too is unemployment was a little over 6%. So unemployment has started to run a little bit hotter during this decade.
Yep.
You had the 18% in the 30s, I think 5 or 5.5 in the 40s, 4.5 in the 50s or 60s. Now we're hitting this 6% unemployment. So unemployment's starting to creep up, and then that kind of brings in the 80s, and this is where we've turned termed the phrase Reaganomics. It's when Reagan kind of introduced this thing called Reaganomics, and it's basically reduced taxes, more productivity, less government, all the kind of things we've heard about the last 4 years with the Trump campaign that was in office. A lot of these policies today are still questioned as to whether they really work, but it worked for Reagan to take office. What else do you remember about the 80s, Elias, or from your research?
Well, there was at this point, I think it was the largest one-day stock market decline. It was October 19th, 1987. The Dow Jones fell 22.5%, and that's one day. So that's a really bad day.
So you think about, it's unbelievable. If you think about somebody, they had their statement today, and the good news is back in the 80s, there was no ability to go check your statement every hour, every minute, or daily. Right? You had to wait for the quarterly statement. Could you imagine what would happen? And my question is, how far would it have gone today? And what I mean by that is people that are online checking their statement, they see it go down 5% in the morning. And next thing it's down 10, which most of our systems today are designed to shut the system down so we don't have stuff like this.
Right.
But I would think there'd be a fair amount of panic today if you saw your investments go down 22% in one day, and it's because people have the information that it went down, and they had the ability to act on it more quickly. I wonder today if that wouldn't have been a much larger number if we didn't have systems in place to stop that going down so quickly.
Well, and hopefully today more people are in tune to good financial behavior and making good choices in those decisions. So, I totally see what you're saying. That problem could have been worse, but hopefully people using the right behaviors and making good decisions in times of chaos, hopefully that would be curbed a little bit.
Well, and here's what I think about. The decade ended up averaging 17%. So had people reacted from that one single day and said, I'm out, they missed out on actually one of the best decades we've had.
Yeah, and going into it, if you were to ask someone going into it, okay, over the next 10 years, you're going to get an average rate of return of 17%. But there's going to be one day where your account loses 22%. But if you don't do anything at the end of the decade, you're going to have over 17% annualized return. How many people would agree to that? Well, say I'm in.
The question is, they would agree, but would they actually do it? Right? The question is, could they do the follow through? So really the question would be, hey, if we knew this was going to make 17% over the next decade, could you just not open a statement for 10 years?
Me? No,
But think if you made the caveat, like, hey, the market's going up 17%, but you can't open any statement for the next 10 years.
Could you open the statement but then not sell anything and keep buying?
I don't know. I'm just thinking through, like, because human behavior at some point, greed and fear start to take over. Yeah. Oh man, I'm greedy. I'm fearful. So I think it was a great decade. And if you think about all these decades, there's crises in every one. You had a 22% loss. So the question becomes, what happens in the next decade? We're going to have something like this. It's not really if bad things are going to happen. It's how we react to them. And in our opinion, and you agree with this, and basically the whole office agrees with this, is to have a well-crafted financial plan that you can lean on in times of chaos to help you make informed decisions instead of guessing. Because if somebody sold in the 80s, they didn't have the software today, right? Technology has taken over what we do from a financial planning standpoint. The human element of financial planning is probably more important than ever. People argue computers can do it all. Well, they can do the mathematical calculations and all that stuff, but they still have to interpret the data and then get it to the consumer or client or individual in a way that they understand, which is usually simplifying it. So that's one of the really cool things that's happened since the 80s, and then it ushers in the 90s, which, I'm not even going to look at what this is, but here's what I remember about the 90s. .com, end of the 90s, everybody just doesn't matter. Throw the dart at the wall. If it has a .com behind it, it's going to go up.
Price is going to run up.
Yeah. And I also remember my cousin, which coincidentally enough, he's agreed to do a show in our local area. He was one of the first individuals to host a financial radio show on our local channel. And I had called him, this must have been like 3 or 4 years ago, because we were talking about doing a show together again. And I said, hey, what was it like back then? And he said, well, one guy would be in the studio and, I'd be talking to him. And in our local area, there's like the number one show is this lawn and garden show on Saturday morning. Like that's the biggest call-in show in the area, because every single person is trying to figure out why is my stuff not growing? It's just, he hosted that too. He said, but what happened is this financial show became bigger than that show. And what happened is he'd have one advisor in the studio, and back then they weren't advisors, they were stockbrokers. And there was another stockbroker in the office with all the stock quotes, and people would be calling in trying to get stock tips. And he said, you couldn't believe how fast people were calling in to ask what stocks to buy and sell. And I kind of chuckled, like, they wouldn't even let us mention an individual stock today on the radio, and let alone tell someone whether they should buy or sell. So when I think of the 90s, that's what I think of. I think back to the Sir John Templeton quote we started this with, euphoria, when everybody thinks it's easy. When you make money at everything, we're getting to that euphoric state.
Right. Yeah, and we have been, and it's, I don't know, I guess it has been relatively easy for the last, decade? 12 years?
Yeah, most things have gone up. And I remember the 90s as a great decade from stocks, and it was. Stocks averaged 18%. Once again, stocks outperformed every other asset class. We still saw pretty high short-term interest rates here, just shy of 8%. And this is the last time we've seen high interest rates like that. From the late 90s through today, interest rates have steadily gone down, and we constantly hear people talk about, oh, there's a bond bubble, right? Bond bubble. Prices are high because rates have gone down. And will that collapse? So I remember there's a broker dealer like 3 or 4 years ago that sent a letter out to clients saying, hey, you need to be watching for higher rates. Rates are going up. This could be an issue, because, the prices of bonds are correlated to rates. As interest rates rise, prices go down. And this broker dealer have a lot of clients invested in bonds. It's one of the ways that they built their company. And guess what's happened over the last 4 years?
Rates have continued to go down.
I don't bet against rates. I joked with my mortgage banker. I said, the last time I did a loan on my house, I just said, give me the lowest rate, because I'm going to probably refinance this thing at some point in the future. He goes, well, what do you mean? I said, well, I've been with you for like 19 years. And I took my first loan in the early 2000s, and the rate was like 5.75. And you told me, good rate, probably won't go lower. Then I refinanced when I went to 4.75. And my last loan I did was at 2.75%. Now, it may not go lower, but I've basically been saying that for 2 decades.
Yeah, for the last 20 years, people have been saying rates can't go lower.
Well, and you start to wonder, can our economy even operate at any rate greater than zero? Because people build their spending habits. Unfortunately, in general, most people live to the max, right? They borrow the maximum house, they buy the maximum car, they do everything to the maximum. Can we actually even go to higher rates, or does it implode the economy? We just watch when rates go to 5%, watch what happens to new home building and refinances, a new home purchase. It all starts to slow.
Yep.
So, I just don't want to bet against rates long term. Ushers in the 2000s. And this is really George W. Bush is elected. We see a lot of cool things start to happen. We're seeing a massive resurgence in technology keeps growing. We have a great recession. We saw two of the greatest bear markets we've ever seen. Both went down top to bottom a little bit over 50%. We saw the dot-com bubble where all this euphoria of the 90s and anything you buy with the dot-com behind it goes up. Well, that didn't happen. It started to go down. And then we have the financial crisis of, 2007, 2008, which was driven by this, really easy lending policy and banks really participating in loans that they shouldn't have been. The term ninja loan came into mainstream, and people say, well, what's a ninja loan? No income, no job application, or what I refer to as no income, no job, no problem. Get you whatever you want.
That's the best loan ever.
Yeah, and when I think about this, I think about the movie The Big Short. It's one of my favorite movies, and it's about the guys who tried to predict that this was going to happen. And there were a very small number of people who predicted accurately or correctly that it was going to happen. But the people that didn't, it wasn't just like, oh, I have a whim, like I think this is going to go down. They got a tip from somebody, or someone said, hey, I believe this is going to happen. And they went and thoroughly vetted and researched why it would happen. And part of the movie, they go down to Florida, where one of the epicenters of where this is going on. And they go and they talk to mortgage brokers. They go and talk to individuals. They go to people's homes. And they're like, well, they didn't really even know what they were buying. So they didn't really predict. They put the numbers behind it and said, hey, not all these people can afford these jobs. And I remember in our local area driving around with my wife, and this is 100% fact. I'm driving around. I told my wife, said, I don't understand how all these people can afford $400,000 homes, because I know what people make. We're meeting with people every single day. They're telling us what their income is. I can do the quick math on how much a mortgage of a person making $100,000 can afford. Right. And I just, when I've said, I don't know how they can afford it. Now, I didn't have the insight or the knowledge clearly at that point in time to call this, but I had that feeling like, how can this be going on? And this ushered in one of the most painful decades. It's actually the worst decade since the Great Depression for stocks.
Yeah. Yeah. And as we're almost down for the decade, 0.95%. So almost 1% down annually for the decade. And I do want to point out, so we've gone through every decade since 1930, and we've had two overall down decades. And to me, if you're down less than 1%, I just consider that flat. Like, I don't really feel like I'm losing at that point. So for all of this talk of there's a huge bear market coming and this is going to happen, we're in unprecedented times. When you look at all these decades, things are always happening. In our two worst decades, the stock market was flat for a 10-year period of time. Which goes back to another thing we talk about. We've never had a bear market or a recession. We've never returned to previous highs. That's never happened in the stock market.
Yeah, we've always recovered. In that, the 2000s usher in this new I generation. Right? What's the I generation? It's this right here, the iPhone. People believe that they've had this. Like, if you ask someone, how long have you had the iPhone? Oh, I've had it forever. No, it came out in October of 2008.
It does feel like forever.
It feels like forever. And I remember the first time I saw one. I was sitting at a restaurant with my sister-in-law and her boyfriend, and he has his phone, and he's like, oh, man. I'm like, what is that? He's like, oh, it's this iPhone. I'm like, oh, man, what a waste. Like, I would never use that. And he's like, check this out. So he hands it to me, and we're at dinner with my in-laws, and I'm playing with this. I told my wife, I said, we're going to go get two tomorrow. And sure enough, I ran out to the Apple store and went and bought two. But at first, I'm like, man, I got my first cell phone because my parents wouldn't buy me one, so I had to buy my own. I got my first cell phone, Flippy 2000. Cell phones have been around a while, but I got my first one in 2000 and, barely knew how to text. I started using the same, like, well, this is awesome. I can get my email right here. The first generation iPhones they were great, but they're not like they are today.
What was it? You get music, email,
it was music, email, you get internet, but it was slow. And they had some apps, but it's not, you didn't run your whole life on it. But I never forget that day. I'm like, wow, this thing changed just the way we conduct business. And now even more and more and more people are really utilizing technology. And we've seen the mainstream technology come forefront during coronavirus. People that said they never adopt technology, they were forced to, and now they're embracing it. So part of this, the 2010s, the S&P averaged 13.5%. We haven't seen very much pain since the Great Recession of 2008, 2009, until the coronavirus pandemic happened. People saw pain, but it was quick. I think when I kind of look back to this and I think about all this stuff that we've looked at, if we just kind of eliminate the noise, right, of all the stuff that's going on, all the bad things in the world, and say, I have a long-term vision, I'm going to stick to it. One of the takeaways is that if you had a 100% stock portfolio since 1930, okay, and you invested $1,000 and you did nothing, that would have been worth $4.5 million today.
A $1,000
investment in 1930 would have been worth $4.5 million today. Average rate of return of 9.8%. Okay. Yeah. If you had a 80% stock, 20% portfolio, that 1,000 would have been $3 million. So on and so forth. If you had all cash or, basically all cash and fixed income, a $1,000 investment turned into $260,000. So for some people, what's actually happening is it's not that they can't be successful being ultra conservative, but it's the opportunity of cost of what they could have done and what their retirement could have looked like. And it's one of the things a financial plan will do for people. It will help them overcome the fear of the market and get them off the sideline. If that's, like I refer to, the default option, if you don't know or you're scared, is cash. Because
to be conservative,
you feel like there's no risk.
Right.
In my opinion, cash is risky. It doesn't beat inflation. You're losing money every year and you're in cash. So Elias, we summarized a little bit about why it's important to have a good financial plan, a good asset allocation. And I thought it'd be a good way to end the show, since we started the show with a quote from Sir John Templeton, and this white paper was put out by Franklin Templeton, tended with a quote of his. And you don't even know I'm going to do this, but this is the quote, and you'll think it's a good one. And it talks a little bit about this whole past 90 years of investing. And he said the only way to avoid mistakes is not to invest, right? I mean, if you're going to invest, you're going to make a mistake. We don't always pick winners. Some things go up, some things go down. The goal is to, over time, do well. So the quote is, the only way to avoid mistakes is to not invest, which is the biggest mistake of all. And if you think about it, we just look back to the returns over the last 90 years. What had the greatest returns? A 100% stock portfolio. What had the worst? Basically cash. Right? So we'd implore everybody out there, if you haven't done a financial plan, go to btwellshow.com, go ahead and hit get a plan, get in contact with us, and we'll start to help you craft the financial plan. And we'll be able to tell you with some level of certainty what the right amount of asset allocation or equity exposure is for your individual circumstance. Because we make each one of these plans individual. It's not just a one size fits all, this is what everybody does, right, Elias?
Yeah, that's right. It's not a it's not a cookie cutter plan, and it's we have dynamic plans that we constantly update. And I think what a good financial plan does this year has proven it to me. It gives people peace of mind and gives people confidence in their financial situation.
Yeah, I think that was a really good takeaway. So with that, I want to thank everybody for listening. Hope you tune in next time. If you need any help or want more information, or if you have a question for the show, go to btwellshow.com, and we'd be happy to answer the question on air and create a show around that. Once again, thanks for listening. Till next time.